Richard, times are tough at the moment for banks. They're facing increased regulatory scrutiny, there are increasing capital requirements around the world, and also trading conditions are tough as the global economy struggles. How well are they reacting to these sorts of difficult conditions?
Well, I've been having a look at strategy days and recent announcements from banks, and there are really two kinds of response. There are those that seem to say this is a cyclical change in the market and things will bounce back and it's going to be fine. And there are those that are saying this is a more secular change, a more structural change in the market. And the first example would be Deutsche, which came out with its strategy update last week and said we're going to try and achieve an ROE of 12% by 2015, but we've still got cost to income ratio of about 80%. So not sure that's going to happen, but it seems to be in a little bit of denial about perhaps cutting as hard as it should. So it still seems to treat this as a cyclical change. Then you've got Nomura, which is just cutting costs in London and, if you like, retreating to what it's good at in Japan, which is fixed income, and it's going to be flogging stuff to Europe with an Asia flavour. So I think it's right-sizing itself, and it's realised there is a secular change in the market. So two sides of the same problem, two approaches.
So Nomura is very much going back to its heritage in Japan after an attempted expansion into Europe after the financial crisis.
Absolutely. I mean, the thing about Nomura was it was always a house that sold Japanese government bonds, and Japanese equities into Europe, but it then expanded through the Lehman acquisition when it bought Lehman Asia in Europe in 2008. With that, it inherited a colossal cost base that was out of all proportion with the actual performance of the unit. So there's been a reality check, I think, and the Japanese house is actually going back to what it does best. Now, I think that's, if you like, an admirable outcome. And contrast and compare with, not picking on Deutsche in particular, but it just happened to have a strategy update last week, and it exemplifies the kind of banks that are not quite recognising that things probably really have changed. This is not going to be a quick cycle up and down or down and up. There's going to need to be serious cost cutting and serious structural change.
Does Deutsche have the balance sheet and the financial strength to see things through, to make it through if it's expecting an upturn?
It has until now thought that it had, but there were signs at the strategy day that it was admitting to balance sheet weakness. And I think, if anything, the German regulator, which has indulged it for quite some time, is going to put pressure on it to boost capital. So if it had the capital, it would have the luxury, if you like, of wielding the scalpel a little bit more gently than it should be doing. But I think the reality is that it's got to build capital at the same time as somehow extracting higher returns on a broader equity base. It's setting itself up for a real struggle for the next few years.
Well, I suppose the next few months will tell us which one of the two, Deutsche or Nomura, has the right approach to facing these tougher conditions. Richard, thank you very much.